Good morning. This is Sherwood Tucker with American Ag Marketing from downtown Chicago on this Tuesday, October the 14th, 2013 at 8:58 a.m. with this morning's grain comments. A couple quick macroeconomic news items are that Washington's supposedly close to a deal that would raise the debt ceiling through February the 7th of 2014. And at this point, the bond interest rate markets are factoring in a 2% chance of debt default, which isn't that much at this point, considering last week. The dollar is rallying sharply from this news. Crude oil is lower by about 80 cents at this point, and the gold markets rallied back up off its lows. It was down about $15 earlier, now down only about $3. As we look across the board here, the December corn futures are up about 1.5 cents at 438.5, with March at 451, up 1 1/4. We have November soybeans down about 5.5 at 1267.5, with the January down about 5 cents. December wheat down 3 1/4 cents. The March down 2 3/4 cents, with Kansas City December down 2.5, and the March Kansas City down 2.5 as well at 756.5. Couple news items in the grain markets are overnight and this morning, corn continues to trade along the contract lows with low volume still. Yields are still being reported at records or near records in the big production states, and the trade is now starting to turn its focus to the harvested acres number and whether the USDA is going to make a slight reduction in acres, 500,000 to 900,000, or is there a reduction going to be more aggressive, 1 million, maybe 2 million acres. Regardless, our bets are still on a new record corn crop being produced this year in the United States, with all the fundamental backdrop and numbers that have been reported, and the USDA rarely goes to full extent and is that aggressive on its balance sheet. An interesting point I did read this morning is that since 1983, corn futures have never made yearly lows in October, and with analysts still thinking that we're still 3 to 4 weeks away from what they consider harvest lows. So look for these lows at the 430 area to possibly be taken out in the month of November when we do get to harvest lows due to the late planting we had this year. Technically, $4.50 to the upside would need to be taken out for this market to be considered bullish, and $4.30 still remains key support. The spreads continue to remain steady and sideways. If we do get a strong rally in the dollar, look for that to limit any upside in the grain markets today. Going on to soybeans, also quiet and steady trading overnight with no new weather events throwing any wrinkles into the mix. Lack of export news verification seems to be keeping a lid on any rallies, and the NOPA crush numbers are expected to be low due to late harvest, and oil stocks are expected to contract once again as well, which might throw a bid under the bean oil market. Basis is strengthening in some areas and should continue into the weekend as less harvest will take place with the current weather fronts that are moving in. Spreads are stronger, with the November-January widening to over a penny inverse again this morning. And technically, beans are testing support again at 1266 area down to 1260. And as we stated yesterday, $13.05 to the upside would need to be taken out in order to open the door and consider bullish positions in that market. That's it for this morning's report. Again, if you have any questions or comments or concerns, feel free to visit our website. Get in touch with us at www.americanagmarketing.com. Give us a call at 312-987-2072, and we'll be happy to help you out with anything you might need. Have a great morning. We'll be back to you later on in the day with our closing market commentary.